I know.
Nice touch.
Need to get yours up there, see how things went today.
I used to always have CNBC going in the background. I felt it made me look smarter.
Well, I think we can probably get started, and we've got a few students on. Don't want to waste anyone's time, trying to hop into it. So, John Swallow, the CEO of currently New Jersey Mining Corporation, is with us today. We sent out some company presentations in advance, so hopefully you've had a chance to look through those because we're going to just dive into questions and answers. I prepared a number of questions so I can lead the discussion if necessary. If any of the students have questions, just let us know in the chat that you have a question. You don't have to put it in there, and then we'll get you on the next opportunity. We are recording this, so anyone that's not available will be able to, or wasn't available today, will be able to see this presentation. Following the presentation, we'll also have another opportunity for questions. You can submit those to me by email by the end of the week, and we'll forward those to John for answers and then get them back to you as soon as possible. That said, I know I need to take the important step of showing the forward-looking statement. So covers John when he tells you all of the company secrets. They're no longer going to be MNPI. So shared that. And all right, with that out of the way, lead off kind of what brought you to NJMC. John, I know that you started out as an investor. You followed the company for a while. So what really drew you to the company and started this journey for you?
So I've been following the junior mining industry since I was a little kid. So back when they used to actually follow, when there was a lot of mining companies listed on the Spokane Stock Exchange back in the day. They used to walk by the brokerage down here in Coeur d'Alene, and they would change the stock prices with it was on a chalkboard. So that, it was really kind of a cool thing, but it really got me interested in investing in businesses and that you can own a share of a business and that kind of thing. And being that I've kind of always been a little bit of a store of value prepper, kind of not prepper, but prepping I just always want to be prepared for. I never was really big in the fiat currency world, even as a kid, following inflation and you're out mowing lawns and the money you made today wasn't worth the same tomorrow, kind of a thing. It's really, it was just a lot of that kind of thing. I really, when I graduated college from Arizona State, I came back to Coeur d'Alene. I ran my own appraisal business for 15 years, but invested in on the side, kind of did my own thing. And it's the investing side that allowed me to retire, and then kind of pick what I wanted to do next. And oddly enough, that was to jump in and really test my skills in building businesses, essentially.
All right. So I think that kind of one of the big challenges with mining companies is they're a blend of the underlying commodity and then the operation itself. So especially as an investor and then now an operator, how do you tease apart those two elements in valuing a company that's both an asset and an operator?
It's interesting because there's a lot of folks that they get kind of stuck in the blue sky side of it, and they want to go out, and essentially the way the industry works is a lot of it's exploration, which means guys go raise money, they go drill holes, they hope to prove up a resource and then sell that resource to a larger company. Or essentially they're mining investors as they go, they're raising money, they're paying themselves salaries. They never really build, or for a large portion of them, never really try to go after building a business because they really can't. And it's the hard part. The hard part is turning something that starts as an idea into something that can actually generate cash flow and then actually generate a return for investors. And so I've never really shied away from taking the more difficult path, but the way I do things is I always put my money in first. The first $1 million in New Jersey was my own. I didn't take a salary for the first 5 years. I'd rather, there was a really good geologist I would have rather had on staff. I'd rather have paid him than pay myself in the beginning, and he's He's Rob, the guy you've seen and heard in some of the videos. So, separating out kind of those that can and those that I don't want to say can't, but just have a different outlook on the industry. And as an investor, I've invested in both. So I've invested in the blue sky only, the guys that I thought, they were going to try to make a go of it. But your time frames and your investing horizons are totally different. Those are way more speculations than they are investments. I always wanted to build something that I wanted to invest in myself. And really I think I mentioned it in one of the videos, but we do listen to the business and we kind of take our path. And if it fits other people's investment criteria, that's good with us. And if it doesn't, that's also okay. We're fine with that. And some people kind of come and go too. So I'm not to answer your question, but that's, I've done fairly well on the investing side, but that's only because I had a fairly good grasp on how to build a business as well, and I've had a heck of a learning curve. I will say that.
So I guess maybe digging into that a little deeper, gold as a commodity, it has a price and that fluctuates, day to day separately from, the value of a miner. So kind of how do you look at the price of gold and make determinations about, operating the business? When is it, profitable? When is it worth exploring more? Kind of do you do any hedging activities?
Yeah, I'll answer the last part first. So as far as hedging goes, we've done a little bit in the past, but not too much. So this is a good lesson. So I hedged one time and we did well. And then I hedged another time and basically gave back that $200 per ounce. And so I figured, okay, we're done with that. So it was, it was okay because it served our purpose both times. I was doing it for a business reason because we needed just to be safe we were locking in prices. But in general, we don't hedge at all. We have a really good concentrate broker that we sell to, and they do conduct some hedging programs. And we do have the benefit of that. But those guys are way more qualified to do that than me. And so when I look at the price of gold, the interesting part about gold is it really, whether you like it or not, it's had a market for 2 to 3 thousand years, and it's one of those things where I like businesses where I don't have to worry about, a group or, millennials or baby boomers or Gen Xers deciding they're going to change their preferences or tastes, and the product I made one day is obsolete the next. So the hardest part for us is actually finding the gold, processing it, getting it out of the ground and processing it. But there is an end market for it. And there has been for quite a while. So that's a little bit different than how you see some startups where they're trying to build a product and they're trying to look for market acceptance, build distribution channels and all that. And I'm actually involved in a couple of companies that do that, and I've invested in companies that do that, but it's not my preference. The price of gold, um, we started out building the New Jersey business plan when gold was 1,080 an ounce and nobody wanted it. And we were building a company that we were looking at needed to be right around $1,200 an ounce in costs in order to work. So we were going to basically build it during the tough times and ride the wave up into the good times. Because it's, and I said it in one of the videos, it's like you build businesses in bad times, you don't build them in good times, and especially in this industry.
So I guess maybe even extending it a little bit further, once you do extract and refine the gold, when do you decide you actually want to go to market with it? I mean, it is a store of value, and so, when do you feel it's valuable enough to actually sell versus, holding it as an internal kind of final asset?
So if we had, say we were a much larger company, a Newmont or a Barrick, and you had millions and millions of ounces in reserve and that kind of thing, you might structure your different deposits that have different grades for different sort of market environments. But right now we're mining as we go, and so we don't really look at it that much. Now, if gold was to drop back down to say 1,200 or $1,100 an ounce, we would probably, well, not even probably, we would stop mining, but we would keep exploring. So we'd keep drilling and adding to the resource and that kind of a thing. So we don't look at it as much as if we're worried about the day-to-day fluctuations. We know one thing, that it's going to fluctuate, and so we don't worry too much. With the environment, it's really more of a macro look. Like, is the environment and the overall global picture favorable to being a gold producer? And yeah, the answer is yes. That's really what we look at.
You mentioned some of your competitors there, the bigger names, Newmont, Barrick, probably Hecla, since you're even in the Silver Valley. But I guess, who do you consider your competition? I mean, you're the only active gold mine in Idaho. So is it, Idaho Mines? Is it gold producers globally? Is it other stores of value such as, cryptocurrencies?
I'd say that it's really more of, so once you own your land, and once you have the land, it's like having intellectual property or a patent. Once you have your land, nobody can take that from you. So when you have that, you're not really competing against anybody else once you have it. The key is making sure you don't build a business that screws up so somebody else can take advantage of you at the wrong time and end up with it. So, but as far as like investment dollars, I would say crypto has definitely played a role as the store of value. And I mean, I'm not against crypto. I just think that I think the more things go digital, the more you also need to make sure you have things that are tangible. It just as a common sense thing. But I don't know if that really answers that, but we don't, there isn't really, there isn't really competition. Now, there might be a little bit of competition for labor. In the beginning, when you're first starting out, there is competition for land. Like the land that we acquired over the last couple of years, there were other people looking at that. So you do have to play that game a little bit. But it's sort of a different deal, because the market for gold is the market for gold, and you're selling an end product into it. And the size we are, we don't move the needle for anybody as far as our production goes. I don't think anybody's threatened by our production levels. Let me put it that way.
You mentioned labor markets there, and I know in your videos you mentioned that quite a bit of your labor pool is related, and you felt that that was an advantage. Can you explain why you see that, and kind of where you go to look for labor as you're going to expand, especially into the rare earth mine?
Yeah, so one of the things I've learned over the years. So I started a drilling company, um, sort of on a whim, and then sold it a while back. And when I decided to jump into New Jersey full time, but one of the things, our largest customers were actually in Nevada, but most of our guys came out of here and over into Republic, Washington, in that area, and they all left here to go work down there for 20 days on and 10 days off. And I watched it just destroy families and relationships and all that. And I did not like that business because of that. One of the competitive advantages we have being located in North Idaho is the Silver Valley is a 3 or 4 generation type mining area. And a lot of the folks there have gone away to mine, in Nevada and everywhere else. And now we're a local mine offering local employment. They get to go home at night. They get to be with their kids, their wives, girlfriends, or whatever. And it works out really well that way. And if you look at the older guys, the experienced guys, they know that, and they don't really care if they can go make more money in Nevada. They want to stay close to home. So it's kind of a double-edged sword with us, in that we also, it's kind of part of our everybody goes home at night philosophy, that we not only believe it because it helps everybody take care of their community and the land and environment and all that, but also their families and that kind of stuff. We feel pretty strongly about that. We've worked pretty hard to bring up the younger guys. And to that being said, we've had some young guys get frustrated and say, I'm out of here. And there's a couple of mines they all tend to go work at, and we wish they'd start there so that they knew how good they had it working for us. But that's really, it's a major competitive advantage in this labor market for us, because the guys that are experienced miners and drillers and that kind of thing, they aren't going into the construction industry. They aren't changing careers. They're just looking for a better place to work in that industry. And we're one of them.
Can you take us through the strategic benefits of your vertical integration. I mean, I know you guys do everything from, the exploration, you're doing producing, you've got your own mill. Kind of, what were the strategic decisions behind that, and how do you view that as an advantage or disadvantage versus your competition?
So the exploration side, so a lot of the industry starts with exploration. So let's just say you've got this area and that's where you think that there might be gold there. And the geologists will go look at it and they'll do their initial work, mapping and sampling and all of that. That's very early stage greenfields kind of exploration. The next step in that process, if you like it, is to drill it, to drill down deep and see what's there, model it, and then the next step after that, assuming all these levels of success, is you then would raise the capital to build a mill and start development and all of that kind of thing. So these are all parts of the process. And then part of the process, you've got mine development, and then you have mining, and then once you get the ore out of the ground, it goes to a mill. And all of these levels are levels that if somebody else owned them, they would take a piece of you. So it really hurts the economics of a small operation to outsource all of that. So we do outsource our trucking from the mine to the mill, largely because I didn't want to get into the trucking business right away. And that's more of a commodity anyway. But it really comes back to if you look, so we actually drill for about 50% of market costs. So we get twice as much drilling than we would if we hired a contractor. And it just happens that I had a drilling company, so I know what it takes and what it looks like to have one or two drills and drilling crews that actually can add value instead of just kind of show up to work every day and just drill. And so I always tell everybody there's a big difference between how a drill runs at a drilling company and how a drill runs at a mining company. You want the drill to run at a mining company as if it's a drilling company drill, trying to make revenue off of that. And right now, that's what we have. And so if you can build these different components so you're almost like profit centers, you can do okay starting small. Otherwise, you really do have to start quite a bit bigger. I know it didn't necessarily answer your question, but being vertically integrated is really important to us starting small, especially if you have the personnel. If you don't have the personnel, it would be a disaster. Or if you didn't start with, your kind of your field generals, your guys with experience in all these different areas, and then together you build out those teams and go forward. If you were to start out and hire a bunch of young guys, it would be a lot of great energy and no direction. And so you really do need that mix. And if I would have done this 15, 20 years ago, it would have been a disaster. But we're all kind of working under the benefit of experience here. And so we were able to do this. Now, the best part of the business, the best part to make money at in our business is probably if we just owned a mill and didn't own any other part of it, and people had to ship their ore to us, because the mill is the hardest part typically in a mining area to build and permit and run. And that's kind of a little bit of a profit center if you can do that. So I always say the money's made at the mill. So anyway, that's kind of it. Ask me tomorrow, it might be a different answer, but that's pretty much what
I
it
know.
is.
So I know every presentation you get asked, an ESG question, and I know you covered them in the video, so we won't do the high level, and I know your mill has a pretty good record there with the, no water leaving the mill. So have you started, I guess, looking at your ESG scoring, especially on, more major scales like BlackRock's, against your competitors to try and optimize against them, or are you trying to look more broadly at, competing against, other companies that, could be considered extractive, like, fossil fuel companies?
The ESG thing is interesting. So I look at ESG like most of these things are marketing deals and not necessarily real. I don't think they're. So when I had the drilling company, we had a number of different things we had to do, or we had like an environmental consultant would come in and he'd have a checklist and we'd go over it, and you give the guy 50 grand a year, but you only did it to cover your own backside. Like I just didn't think it was any value added at all. I just thought it was part of playing some game. Um, I'm not saying it's wrong, but what I'm saying is it needs to be real. Like, so what we do on our side is like, if we think something needs to be done better, we do it better. If we think, like we have a property that Rob and I acquired a couple, 3 years ago that needed to be reclaimed. We acquired it with the idea of never mining it, but we thought it looked like crap, honestly. And so we've done all the reclamation ourselves. We haven't told anybody about it, but that's how we do it. I think going home at night is another one of those things, because if everybody cares about where they work, they also care about the land and they care about their communities and all of that. That is a component of that. From my own personal side, I work on land conservation stuff all the time. I'm working on it personally. I've restored this old train station here. I floated a house across Lake Coeur d'Alene and rescued it. Like those are real things that I think tell the story about the people. Um, I, especially as a small company, I think it'd be dangerous to get caught up in some of the slicker ESG type consulting groups. Like I'm not sure it's real. And then I think when you go to put a mine into production in a new community, I think people see right through that. And I don't know that it actually works right. I think if you do everything right and you're honest about it, people can evaluate you and what you do, and then the people of that community can make a decision. And that's the way, I mean, we just take a very honest, straightforward kind of approach to this.
All right.
Which the NYSE will probably tell me isn't sufficient, to be honest with you.
Well, I think that's kind of where, I was starting to lead is that, as you're, moving on to indices and, ETF families, in the investment world, ESG is a major topic. So I'm sure it's a question you continue to get asked. And I think it's probably the right approach not to be trying to game, for a specific metric, but
Well,
be competing against companies that may be. So it'll be interesting to see how the exchanges view it.
Monique, our corporate secretary, we're the only two people in the office. Everybody else is in the field. But, the mining, we've been under the microscope forever. And rightly so. I'm not real fond of the way they did things in the past. But I also have seen a number of instances, and it's a real thing where, we're Americans, we can do this stuff right. And I always call it, don't move the goalposts. Like, make them as strict as you want, but don't move them and don't say no to everything, because mining will still happen. It's just going to happen in South America or Africa or somewhere where nobody cares about the environment. And so we're not really doing anything better by keeping it out of the US. We need to really keep it here and regulate it and watch it so it doesn't happen willy-nilly kind of in other places. Because it is a real thing. I mean, the profit motive in other countries, they don't, a lot of them don't care about the environment. So by net, you're really hurting the environment by being too strict in the U.S. Or I wouldn't say strict. I would say not in my backyard or absolutely no mining ever. I think it really just needs an honest look, not as much of a blanket no.
And I think environment with mining is, obviously top of mind, but how do you view the other legs, the social and the governance? I think as an industry, mining, doesn't see as much gender diversity as many others. And so do you have any initiative to address those other two legs of the ESG puzzle?
Oh shit, I don't care. If you're a little green man from Mars, if you can do a good job for us, you're hired. It doesn't really matter to us. We don't, I don't even know if it's still in my bio, but I mean, we live under what we call a combination of the golden rule and the no asshole rule. So if you fit within that, we don't really care. We're pretty much agnostic about as far as that goes. It's really just the experience, and everybody's welcome. It's not that part of it is not an issue with us. You're working in a hard job underground, and everybody needs to be able to trust each other, and that's the key to it. And that's the key to everybody going home. It's a really good group of folks in that manner. you know, yeah, Monique's kind of reminded me of what I'm not saying. But she's on the Women's Coalition for Mining and stuff like that. And, you know, we, we are seeing, it is naturally, you know, a lot of, and especially like the geology field and that kind of a thing. Like most of our staff are women on the geology side. So, um, you know, the underground, let's face it. I mean, that's big tough guy kind of. I mean, I'm not there, so I mean, you know, those guys are pretty big dudes. They're experienced, but our geology staff is 2 guys and 4 women. Um, like I said, we don't. It doesn't matter to us if it's just whoever does the job right, um, and we're just open. Yeah, it's just that's our thing. I mean, we just don't want to work alongside people that are jerks. Oh yeah, that's a good point with Monique. See, she's telling me all this stuff. So, our best haul truck driver is a gal as well, and everybody knows it. I mean, and if you look back at my Facebook posts, a lot of our Facebook stuff over the last 2 years has been really for our employees and their families. And Lori, one of the haul truck drivers, she was telling me that her family in Wisconsin, that's how they keep up with her, is seeing what we're doing. And she's by far the best haul truck driver we've got. And there's another gal that I would say is number 2. And then there's all the rest of the guys. But you know, I try to highlight, I try to highlight everybody. And I also try to highlight everybody I can kind of give a hard time to. Because like I said, our Facebook page tells us a lot about our culture and kind of how we see ourselves. We don't take ourselves too serious, but we are serious about what we do.
Moving to maybe a more question, if you look at the, you know, value of your 254,000, you know, verified ounces of gold available, you know, it sounds like, you know, you're not going to extract if it's less than $1,200 an ounce, so that's probably about break even on cost. So, you know, if gold's at 1,800, you have $152 million of, you know, net profitable gold in the ground. Your current market cap is $65 million. So, you know, having been in the industry for so long, what drives that big discount at your market cap versus, you know, the proven reserves that you have in the ground?
You know, it really has to do with, I think the size of the company is one. You know, if our resource sat in Newmont, well, first of all, it wouldn't move the needle much, but you know, you would be pretty much guaranteed they would find, if they would mine it, get it out of the ground and do that. You know, one of the things we're doing that's different than a lot of these larger, more established companies is we're also growing as well. So like what you see as a resource that we have, we are growing that resource, our land base, and the future like crazy. So that blue sky side of it is quite promising for us. So I'll be honest with you, I have never done that math. I don't really look at it that way. I look at it, what can we get it out of the ground for? Um, if we're having good exploration success right next to where we're currently mining, those are ounces that have a ton more value to me than ounces that are a mile or two down the road. You know, so it's a lot of those kinds of decisions is how we look at it. Yes, having the large, sorry, that's a dog barking. Not sure at what, but it's okay. She'll bark to want to get back in here in a minute. But that's really how we look at it. You know, one of the things we were listed on the Canadian Stock Exchange for a little while, and they wanted us to show this, like they wanted us to drill out this massive resource, and then they wanted to do, it's called a 43-101 report, which is essentially what you're talking about, where you take the, you know, the net present value of a certain number of ounces and, you know, whatever, and figure out the cash flows and all that, feasibility studies. And the thing we looked at was, well, by the time we get it to that level, we will have already mined it and sent it to the mill and have revenue from it. So there is a little bit of a, yes, we're going to grow our resource base, but we're also going to mine it as we go. So we're looking at it from a business standpoint and not necessarily a growing our resource base standpoint. So I guess what that does is it tells you it's not exactly X number of ounces, X costs, because one of the things we're doing is our rare earth element exploration programs. They add to our cost per ounce at the mine. You know, our drill holes down the road that have nothing to do with production, they add to our cost per ounce. So if I wanted to make the financials look a lot better, it would be really easy to do that, but you'd be borrowing from the future in order to do that. So I know that's not necessarily exact answer, but it is how we look at it. We're continually investing in growing every dollar we make goes back into the business. So when we got to a certain level that I felt we could add a drill, we added our drill, which is a $600,000 decision and a $30,000 a month decision. And then when we got a little further along, we added a second crew to that drill, so we were drilling 24/7. And those are decisions we make. We didn't have to do that. I could have easily saved that 60 grand a month and that $600,000, and it would have, the financials would have looked completely different. But we reinvest everything. I think you're going to find that we're the type of company that's always going to be a little bit asset rich and cash poor. It's just at this point in a gold cycle, and even with the way the rare earths are going and the way the world is changing, I think it's kind of the prudent way to go right now.
You talked a little bit about growth, and I think we'll get to rare earth a little bit later, but especially the gold side of the business, it's a finite amount. So kind of how do you sustain beyond the current, kind of verified reserves? Are there improvements in your, extraction technology? Is it just purely a growth in claims? Kind of how do you keep that gold side of the business sustainable beyond kind of your current proven reserves?
So it's a little bit of, it's almost like two different parts of it. So the property acquisitions we've done over the last 2 years, that's the base. I mean, that's a really highly prospective property package that we have. And then right now we're currently drilling right next to where we're mining with the drill. So every drill hole that we drill adds future ounces to the mine. So that's what I was saying. But by this time next year, we will have mined that. You'll never know about it. I mean, it'll be, there won't be any major formal reports on it or anything like that. But what we're working is always having 100 to 200,000 ounces out in front of us, and that's really what the drilling does. So we can do exploration drilling, which is 5 to 10 years down the line, a larger mill in the area, that kind of a thing. When you get those ounces, and then there's the ounces that's right near where you're working. And if you drill a drill hole right next to operations at an operating mine, and that drill hole is successful, that drill hole has a lot of value, because you don't have to go build the entire business in order to extract value from that drill hole. So that has immediate value to your bottom line and to your business. And so right now, if you look at our press releases, and we can go over it again sometime, but we're mining in what I call, there's like a middle area or a middle chute. And earlier this year, we drilled in what we call the Paymaster and Joe Dandy. And then to the north on the other side of it we're drilling right now is an area called the Klondike. So we're working right now in production out of one area, and we're going to expand into 3 areas. And so it's real easy for us to make the decision to go develop over and mine in these other areas when we've drilled out ahead of ourselves and we know what's there. And so again, it probably won't be in too many formal big time reports other than us talking about it and telling our results and doing that kind of thing. So it's just 2-pronged. You got the early stage stuff that you're going to go look at in a while, and then you got the stuff right by where you're working that is something that every producing mine does this every day. They're drilling out in front of themselves every single day.
All right, and when you find those new ore shoots, do you get to name them or?
Yeah, we do. We some guys come up with some pretty strange names, but I told them a couple names that I think we need to start using. Really, we've named them after folks that are either historically, from the area, or one of the guy's dogs. We're naming one of them after his dog, and there's just kind of there is one fault they call the BA fault, which you could starts for, well, just this big ass fault. That's kind of what they were calling it, so they named it BA. I mean, it doesn't get any more complicated than that. Anyway, but yes, we do name them. But everybody, I will say, everybody's very superstitious. So it has to be like the miners have to agree with the name. Like there can't be some weird thing that's a quirk that the miners don't agree with. That it's just sort of how it rolls.
I'm sure there's lots of superstitions in the mine, not just in the naming.
No.
So I know you touched on your mill a little bit. How much of its capacity is contracted versus, for internal milling?
So it's 100% ours as far as the use goes. Now we have a joint venture partner that has the right to use about 70% of the production capacity, but their mine is not anywhere close to producing right now, so we don't really worry about it. And we're on a sort of a 2-year plan to build a new, larger mill near the mine. Right now, we truck it about 45 minutes to the south, and that adds about 10 ton to our costs. So we immediately can save, 50 or $100 an ounce in by building a mill near the mine. We actually one of the things we want to do with the new mill is the tailings or the waste rock or the waste material. It's just basically like mud. It comes out in a sort of a slurry. It's a paste, and there's nothing bad in it. It's just paste, mud. We actually can mix it with concrete and put it back underground and sort of reclaim the stopes or the areas where you mine as you can put that back underground as you go. And so one of the things, if we have a mill up at the mine, we can do that as well. And that saves us like $1 million to $1.6 million a year by just doing that. So you eliminate trucking costs, which is around $1 million a year. You build the mill, you do the paste backfill system. That's like $1.5 million a year. So there's a lot of savings that we can do by building a mill at the mine. And then it makes a lot of your other ore economic. Like we have a stockpile of ore right now of 150,000 tons at the mine that's uneconomic to ship to our mill. So there's a lot of things to look at. When you mention the mill, in my mind, there's a lot of pieces to that fit the mill. We toyed with the idea of contract milling, where you basically bring in extra ore from other places, but it's a very difficult managerial process because everybody drops off their ore and they expect it to have a certain amount of gold or silver in it, and oddly enough, they always expect to have it to have more gold in it than you find, and so it just ends up being a major problem. It's a managerial nightmare. If we didn't have a mine going, we would have a custom milling. We would utilize the custom milling aspect of it. We would figure out the process to basically purchase the ore when it's dropped off, but that's a whole different can of worms.
I know in one of the presentations, especially Hecla, they got into some technological advancements within the industry. Are you pursuing any of those, or is most of your investment on kind of expanding the current mining operations?
We do have a couple of our underground haul trucks actually you can run remote. But a lot of it has to do with the modeling and that kind of thing. That's really where we use technology a little bit. There's a lot of kind of like geotech type work and magnetic surveys, and we use a drone to help model our stockpile. I mean, we're advancing right along with everybody else, I guess, is the way to discuss it. But mining is one of those areas that it is one of, how people say, when you ask them, why do you do it that way? They say, because we've always done it that way. Boy, mining is one of those areas that has been stuck in the past for a long time. Hecla's working on their remote miner, but that's also because they're 9,000 feet below surface. We're nowhere near that. So will we be there? Yeah, we could eventually be there, but we have to incorporate technology in, as a small business would do as we go. We don't really have the luxury of just making a blanket change, I guess.
Um, I know, and also one of the presentations you know focused on the pivot that you're really going through the move from a smaller company to a bigger kind of long-term sustainable
Yeah.
mining company. What are some of the next constraints that you're seeing as you're growing that you're having to overcome? I know you talked about adding the new mill on site. Like, just what are the other areas where you're constraint bound at this point?
Yeah, it's interesting. So the last press release we had out, I did discuss one of the areas specifically we're working on right now, and these are just, a lot you'll find from the press releases, just mine, that I tend to just talk, but I tell people what we're thinking, what we're doing, because if you don't like how we think or do stuff, I really don't want you calling me telling me about it. Just don't invest. I mean, it's really how we look at it. But if you read in one of our last press releases, I talked about one of the things we just did was we're working on upgrading our systems. Like, so up until now, each guy was ordering parts and stuff out of their area, the shop, the mill, and when I had the drilling company, one of the things that uptime is very important to profitability, and reliability is important as well. And so you really can't have that. When you get to a certain level, you need to start adding certain layers of people that actually allow you to do things better, and upgrading equipment as you go. And so those are, it seems very basic, but when you start out, you start out with the cheapest, kind of lousiest equipment you can, because you're starting, and then you upgrade as you go and you reinvest. And that's really what we're doing. And we're doing that in the people as well as in equipment and processes. Um, we're getting ready to do on Thursday, we're doing a presentation for the miners where we're showing them the kind of the future mine plan, where we're going, what we expect to find, drill results, and that kind of thing. So you want to show these guys what their day means to the bottom line. So you don't want them to just show up to show up. You want them to know the goals, how they can play into that. So this is all part of that pivot that I talked about. It's all of this. I mean, it's all of it. And then the other part of it is also growing our investor base as well. Right now, we don't have any institutional investors. Part of that is because of where we're listed. And part of that is, I'm sure, share price and restrictions on share prices and that kind of stuff. So there's a whole bunch, there's a number of things that go into this pivot that I talk about. And we're doing it. I mean, I get probably 10 texts a day from the guy now that's the purchasing guy. Careful what you ask for. He's just owning it, but that's what everybody does. And the shop guys are doing the same. And you really can't get bigger until these processes. Like, what you find is you go around as sort of an ecosystem, and there'll be one part of the ecosystem that's the bottleneck, and you got to make sure that's no longer the bottleneck. And then there's another part of it's a bottleneck. And so these are really just processes. And again, if it was 15, 20 years ago, we wouldn't know what to do. But because we all have the experience of business, we have a pretty good idea of what we're doing.
And I know as a part of that pivot, you did do the proxy. I don't think I've seen if you've announced the results of that proxy, to reverse split, and try and get listed on the NYSE Amex. Can you talk about that proxy?
Yeah, no, it was in a press release, but it may have been down a ways or something like that. We also filed 8K on that, but yes, it was the one for 14 reverse was approved by our shareholders. Right now, we're working with FINRA. FINRA is kind of the gatekeeper to uplisting, so we're working with FINRA. The NYSE, we've already worked with the NYSE. They're just waiting for FINRA to be done. They've essentially approved us to apply, which means we have already gone through a large portion of their process for the NYSE. It's the NYSE American or the NYSE Amex. It's that layer of the NYSE. So once FINRA is done, we it doesn't really matter what the shareholders have approved until FINRA says that they're okay with it, which that's another, yeah, it's a, like Monique said, it's a corporate action. So they just say yes. It's like they don't really ever say no, but they just want you to give them enough information so they feel comfortable in saying yes, which is really filling a file, I think. But we're a pretty straightforward business. The guy at the NYSE we're working with, I think he actually really likes us. I think he's not really likes us, but I think he likes our business. He likes the fact that we do things. We've been around quite a while, and we're just a natural business that's growing, kind of a thing. And it's not too difficult to understand. One of the things I mentioned in it was one of the presentations is it is interesting. I've had a number of wealth management guys that own our shares personally, but can't put our shares in their clients' accounts until we get on a higher exchange or have a higher share price or both. And I never was a big fan of reverse splits, but this is the one time where it makes sense to do it from a business standpoint. Otherwise, I think it's sort of I just think it's wrong to judge a company simply on share price. There's so many things that should go into that analysis, but fully reporting SEC reporting company, we're audited. Our auditor is Hekla's internal auditor. I mean, to me that should mean something, but I guess I kind of get it. But I also think sometimes these risk profiles at these places, sometimes I think they don't allow folks to get into something early. They make them wait till later, till the price has gone up, and apparently the risk has been removed or greatly removed. So anyway, that's a little bit about that.
So I guess one risk to shareholders of that reverse split, and especially moving to the listed exchanges, it'll be easier to project finance through dilutive means, right? You'll be more able to issue equity versus currently you're just funding through operations and private placements. So are there plans to mitigate that risk for current shareholders, or kind of what are your future plans to finance versus debt versus equity?
Yeah, I imagine we're gonna see a combination of the two. But if you think about the future, well, right now we're trading higher than we ever have. And so as far as dilution goes, I think it's fairly good dilution if we do have some, but really we've always looked at all of the angles when we go make a business decision. Keep in mind, I am the largest shareholder, so and my entire family and friends and everybody, they're all shareholders as well, and all of our employees are shareholders. So we definitely have a focus on analyzing different paths. We're not really interested in a quick hit or a kind of a crappy death spiral type deal. We get pitched deals all the time. I tell guys, no thanks. One of the reasons I wanted to get to cash flow as quick as we could is so we had some options when it came to raising money and had the ability to say no thanks. That's when you look at some of these companies, having the ability to say no thank you is something that is so valuable that I don't think shareholders understand the pressure that management teams can get themselves into. And it's prevalent. There's a lot of loan to own type of finance guys out there. We don't do any of that. If anybody spends any time around us at all, they'll know kind of how we work. But we've gone this long without any institutional holders, so we don't have any preferred shares out. I don't have a guy sitting on the board telling me what to do based on his exit strategy and not what's best for the business. We really focus on kind of just doing what we think is best. So I guess the answer is I can see it being sort of a combination of the two. But let's face it, the rare earth side of things in gold, if our stock runs like crazy when we're uplisted, raising money with higher price shares would be a good idea. That would be building a new mill is immediately accretive to our shareholders, and really and I'll go into this in just a little, just for a second, is the fact that we're a producer and in Idaho and we've proven ourselves to be good operators, has helped us with a lot of these agencies on the gold side and the rare earth side. So even though we're a small business, we've actually shown that we are a business, and that we've been kind of prudent about it.
So I wanted to take us down the rare earth side a little bit, since that's kind of one of the big areas of growth. And then the next step, right, is the, 10 holes, for exploration. Can you kind of take us through what the outcomes of those, drillings would be, and what that, what the different outcome or potential of those 10 holes could be, what the next steps would be following that?
So, assuming success in the 10-hole program we have at Diamond Creek, it would basically lead to another drill program. Quite honestly, it would drill, that would be something you would take the information you learned from that 10-hole program and expand that program. And you would really start expanding and building a resource base. One of the things we're doing with the University of Idaho, and it's really this program we're doing through the Idaho Commerce Department, where they're using the core that we drill. So when you drill a hole, you actually bring up a core sample of rock. They're going to take our rock and analyze it for, University of Idaho is for processing of rare earth elements. And the holy grail in the rare earth element side is to be able to economically process the ore once you get it out of the ground. But because there aren't hardly any rare earth element deposits in the U.S., and we have one of them. That's why and plus we're in Idaho, but we're working with them in order to supply them the core samples so they can continue their work on separation. And then I'm also working with them a little bit on the end product side of it. So it is rather interesting when you look at the fact that our Diamond Creek property is like the number 3 rare earth element deposit in the U.S., and that was defined by the USGS, the United States Geologic Survey, Department of Energy, and the Idaho Geologic Survey. So this, we're not kind of making it up. This is all, it's all information that's known. And I said it in one of the presentations, but the rare earth elements were discovered when they were looking for thorium as a replacement for uranium, but they ended up going with uranium because the waste or the byproduct could help build nuclear weapons. Thorium, I believe, was actually considered the cleaner, greener use of for nuclear power, but we weren't as much focused on saving the climate, our climate back then as we were as building nuclear weapons. So, but what came out of that search for thorium is they discovered all these rare earth elements in the United States, but they didn't have a use for them. And so but they all were in all these publications, all these professional papers and that kind of stuff. So I think that it can be pretty big. I mean, I'm betting that way. I put my money where my mouth is on that. I've continued to invest in our own company because of that. And I think we're in a major paradigm shift right now in the world with with transitioning to electric vehicles and permanent magnets and that kind of stuff. And the stuff you find in the rare earth elements, the neodymium, praseodymium, yttrium, niobium, that kind of thing, are the building blocks of what this green future is going to be. I also don't think people fully understand just how much mining is going to take in order to have a green future. It's an extremely high amount of mining. I think people really need to understand that if we're actually going to succeed at this, because right now China has already been doing this for decades and really winning right now in that war.
And I guess to that, how do you manage the commodity risk for the rare earth materials? I mean, the supply chain has increased, demand for U.S.-based, rare earth mining. But what prevents, something like your Roberts site has the 12% concentration, making it, very profitable, or, has a higher profit potential than others. What prevents, another site in the U.S. being, a high concentration in all of the sudden your commodity, risk changes as, supply can change pretty dynamically?
We have a couple things going for us. One is that Idaho is a really good jurisdiction for mining. So as far as having a head start, we've got the head start with the deposit. Um, while there's rare earths all over the U.S., there's not rare earths in mineable or economic mineable deposits around the U.S. So that's one thing to consider. We're not really focused on the commodity risk right now, really, because I mean, what we use today versus what we're going to use in the future, it's going to be very, very hard to meet that demand. I mean, you could have a number of mines go into production in the U.S. and still not meet the demand. So I'm not as worried about that. I do believe we have a first mover advantage, a very good one. And from jurisdiction to the commodity to timing. I mean, it's. I think our timing is very good. But there's risk in anything you do like this. But like I said, I think if we're gonna have like every vehicle be an electric vehicle by 2035 and on, you don't even know the demand that's going to come for these rare earth elements and and other associated minerals as well. I mean, it's we're not talking about a cycle that comes once every 20 years and goes away. This is a shift. This is a once 100 every 100 years, from horse and buggy to automobile type thing. And so I'm not. I guess I'm just not as worried about the commodity risk on that. But part of how we mitigate that too is we don't have a lot of costs in these properties. Like we don't. It's not like our entire business. I mean, it's a relatively modest cost compared to what we have in the rest of the business. So we've come at it from a very logical, um, kind of a logical manner. We didn't bet the farm on it. We really always have a backup plan. One of the things we're also looking at is thorium as well, because the rare earths and thorium tend to run together. So yeah, so that's really how we're looking at it. Um, it's really hard to actually mitigate the commodity risk in rare earths right now because it's really controlled by one place. So you're kind of at the whims of China right now.
I think one interesting thing in your presentations, you mentioned the Earth MRI and searching for new rare earth elements. Have you completed that MRI?
I think it's gone. It might have just got done. So we're our property is participating in it, but we're not conducting it. So the Idaho Geologic Survey is conducting it. And I think it was last week we had a meeting with them and they were flying that day. So they're basically flying over the area and doing kind of electromagnetic type work over an entire area. And they were really focused on cobalt and then asked us if we wanted to include the rare earth trend in Idaho into that. And we obviously said yes. And then we were contacted later by the U of I to join into this other program about the processing of rare earth elements, and they wanted to know if we would join in with them on that, which was very interesting because I've never been in these meetings where these groups are asking us to join in. They're almost always telling us why we can't do something, and so it really is a shift. I mean, it's just from I mean, it's obviously my own opinion, but I have not seen government agencies do a 180 like they have. And I think what's going to happen right now is these agencies are going to do their 180 shifts, support mining, but once they feel there's enough deposits developed and that kind of thing, I think they're going to start gravitating back towards being more restrictive. So I do think kind of the first mover advantage that we have is important.
So
Good luck
I
putting
guess
all this
then,
in a 10-minute presentation, by the way.
um, I guess that's an interesting area, is the regulatory side. I mean, it's pretty well established, in kind of precious metal mining. Do you expect a different regulatory framework for the rare earths?
What I think is gonna, I think they're gonna work with us on the permitting. There's some of these that they'll throw an application on a desk and they'll get to it over time. And I think what it'll happen is they're not gonna, it's not gonna be easier. It's just gonna be more streamlined, I think is what'll happen. Like instead of them saying, I need 18 months to make that decision, well, you know what? You got 90 days. Like I think that's what the politicians are gonna say. I really don't, they're not gonna say you have to do anything wrong because none of us want that. But I do think, in the US, it takes 10 to 20 years to get a mine permitted, and almost anywhere else in the world, it's 3. Like, if we're going to be competitive, why don't we just at least match what everybody else does? Like, we've gotten so bureaucratic in the US that we've found ourselves in this position to where the Department of Defense is reliant on China to build fighter planes and missiles. Like, why is that so? And so, the supersonic missile that came out in the news about a month ago, I'd heard about it about 18 months ago from a guy in the Air Force when we were working on the 3D printing side of stuff, and I felt that they were genuinely concerned that the Chinese had a missile that we can not only not detect, we also can't shoot down. And so they were looking at answering that, and then it took 18 months, and it's in the news. So there's things out there that I think are going to motivate the elected officials and stuff to help streamline these processes so we don't get too far over the cliff.
I know many of these teams will use kind of the traditional discounted cash flow model to, evaluate your company and, especially the rare earth side where there's, some lead time. Can you give them maybe a rough idea of what, the process would look like from, drill to, these initial drillings to, final extraction of those rare earth material elements?
If you assume success, which we always just assume success, honestly, kind of we always talk about a success-based plan. So let's just say that our drilling program is positive in June, July. We move forward with that. I would say you're 3 to 5 years before you were mining in that area. Just kind of give or take. I would say 3 to 5 years. Probably not 3, probably closer to 5. But it really depends on the partnerships. Like if we have Idaho National Labs or any of these other groups that are like, let's go, and we're partnering and we're going out for grants together and we're doing that, I could see it working out quite a bit quicker than that. But it's a tough one because it's not like, I mean, you're talking about an entire paradigm shift, and how do you discount that back? Kind of like good luck with that. I mean, that's going to be a tough one, and if you look at us, I noticed like a lot of some of your companies you guys looked at over the years, they're quite a bit bigger, more established companies where it's really a math problem. When you're looking at somebody like us, we're not only building a business in 2 areas, we're also a small business. And so, there's a little bit more art than science to it. So I would say that discounted cash flow is a tool. I wouldn't say that it's just something to look at. Because one thing you'll find with the in situ value of some of these minerals, if you add up, everything at Roberts and Diamond Creek, you come up with like billions of dollars of rare earth elements. I'm not putting out a press release that says that. It's just not, that's not how we do things. Like you said with the gold, our gold resource and stuff like that. That's just not our way of looking at it. So I think it's really more the size we are. I think with a Hecla or a Newmont or somebody like that, Agnico Eagle or whatever, you could easily do that kind of an analysis, but it's a little bit more difficult with us.
So mentioning your bigger competitors, on a relative kind of valuation basis, what are the advantages of being small versus being big?
Well, we make decisions a heck of a lot quicker, obviously. We have a much smaller board. When you're a small company, you want the smallest board possible so you can sort of travel light, travel far kind of a philosophy. a lot of these larger companies are really more cash flow businesses. They don't necessarily have a lot of mining people and management, or or they do, but it's really more of a money management exercise or banking exercise. Whereas, with us, it's a business. Everybody that's on the board well, there's three of us, and we all have operating experience. And Grant and Kevin, the other two guys, Kevin was number three guy at Stillwater, and then ran part of Hecla's business in Nevada for a while. And so we have, at this stage of our growth, that's what you want to have. As we mature, we will naturally mature into having additional folks on our board that fit different parts of our level of business. So, but as far as I'd say decision making, we don't have a level of middle. This is not going to be politically correct necessarily, but we don't have a level of middle management that really is going to say no to everything because there's a bunch of career risk involved with saying yes. Like, we don't have that. We do deal with companies where you are talking to a guy and he'll tell you off the record, we ought to be doing that with you guys all day long, but I'm not risking my career on it. So nobody wants to own yes. They all want to own no because no is safe. And so a lot of these big companies, you don't see them taking on the risks that a small company can. So I would say from a risk perspective, kind of use us as the AAA or farm team, so to speak. Now, that being said, I told a couple of guys at Hecla before they made their last acquisition down in Nevada that they lost like 480 million in. There were things I had looked at that project years and years ago, and I just told them a couple of things to go look at, and they told me that you don't know what you're talking about. Fine, but there's things like that where there's a lot of ivory tower type of attitudes in these larger companies that we don't even tolerate in ours.
All right. Well, I've worked through my list of questions now. I've fully monopolized the Q part of this Q&A, so I'm going to throw it open to the students, and hopefully they've got some, even though they haven't yet raised their hand. So let's put some pressure on them for a few more questions.
You sure they're still listening?
Hey, John, I have a question real quick. So as you guys start moving more into the rare earth space, how will your customer makeup change?
So right now, when we sell gold, so we have a concentrate broker that buys our gold from us at the mill, and where that gold's fungible. So wherever it goes, it goes. On the rare earth side, I think it's going to be similar to that, but it is going to be a totally different. I'm not sure what's going to happen because there isn't much of a rare earth kind of clearinghouse, or it's going to be one of those things where I think a lot of this is being built as we go. But I can see that we're going to probably be doing our customer will still be some kind of intermediary that we sell the rare earth elements to. If we get all the way to mining, milling, the processing side of it, I'm not sure yet for us if we're going to get involved in the milling side of it. So we may supply the raw materials to somebody else's mill, and that's part of what the University of Idaho is working on right now, is separation technologies. Now, I could see us being part of that, but I could also being fine not being part of that. So, and it's not a direct answer, but our customer may not be the end product guy. It might just be a mill, or some version of that, or an intermediary broker that we sell to, and then they then sell it to someone else.
Thank you.
Oh yeah, you bet. One area that I think will be interesting to see is I think you're going to see a lot of companies kind of a little bit like Tesla did with lithium, and they're going to come down the food chain a ways to help lock up some of these resources, as they become more successful and realize that they actually have commodity risk and they're subject to the fluctuations of prices and stuff like that in these rare commodities. Because those, I mean, you can have prices, go up 1,000% kind of a thing, and just destroy your business. I think you're going to see a fair amount of that. We haven't seen much of it yet, but I think we're going to see quite a bit of it. There's a lot of what I call the process of discovery that I think a lot of these companies haven't gone through yet.
So
Yeah, I
that
got one.
brings up oh, go ahead.
Sorry, this is Eric from the Gonzaga team. I just got a quick question about, as you're kind of heading further into the rare earth side, is there a lot of parallels between the skills and experience needed, that you obtain from, I guess, gold mining? Does that translate really well into rare earth, or are you going to have to hire a lot of individuals that have experience specifically in rare earth mining?
Actually, it translates real well, specifically with our team too, because our team, believe it or not, our geologist level areas of expertise is in gold and silver and basically rare earth elements. So it fits really well with us, and that's one of the reasons we dove into it when we did. Is we had that experience already. I'd been following rare earths for a long time, since the late '90s, early 2000s, and it really wasn't ready for prime time yet. And if we didn't have the staff that we have and the business experience from, we do know what it takes to drill out a resource, turn it into a mine it, mill it, sell it, all of that. And that part of it is very, very similar. Oh yeah, and what he reminded me, we think, and it's actually shown in some of our sampling, that we have gold as a byproduct of our rare earths, which could be fairly beneficial to the economics of a rare earth element deposit when you have gold as a byproduct instead of gold as a waste, or instead of a byproduct that's a waste material.
So I know
Did
in
that answer the question?
Yeah, it did. Thank you very much.
Okay, cool.
So I think at the Q&A at the Silver Symposium, one investor asked about the ability to invest in the rare earth side of the business versus the, whole business of both gold and rare earth. Can you take us through the decision process of keeping the rare earth as a part of, I guess now, Idaho Strategic Resources versus, making it a standalone subsidiary, using kind of that R&D model, maybe from biotech, where you can stand it up as an equity company that doesn't pose risk to the parent?
Yeah, it's one of those decisions. So that gal was actually part of a husband and wife team from Idaho National Labs, and I thought it was anecdotally interesting that they came to an investment conference in Coeur d'Alene and talked to me about rare earth elements. So I think it tells you a little bit about what some folks on the ground are seeing happening out there. Again, anecdotal. They didn't say anything, but I thought it was very, very interesting. I can see if we're successful in the gold side, that somebody's probably going to want to buy what we have on the gold side. I really can see that. I can also see that on the rare earth element side. But that being said, we're going to keep them together and go down the path that we're on. I think as the rare earth element side becomes more developed and is probably more on par with the gold side as far as a development level or maturity level, that will probably be when we take a harder look at spinning. I call spinning it out. So spinning out the current shareholders. So we're building the rare earth element division as if it's a standalone. So that's the way we're looking at it. So we're not looking at it like it's an also ran that's part of your business. We're looking at it like it could be a completely separate business. And if it stays within New Jersey or Idaho Strategic, fine. If it gets spun out or one side or the other gets acquired, I mean, I really think if we're successful, that's the path that's going to happen. I almost can't see. It'd be really hard for me to see us sticking around too long as an entity, one way or another, if what we want to accomplish, we accomplish. You know, I mean, because you're looking at, you know, you expand your gold profile. Well, gold's pretty popular. You know, Hekla's local. A few other guys are local. I could see somebody saying, okay, they've now reached the level. They've de-risked this. We need to look at that. And I've actually heard that from folks. And the rare earth side, I think could easily be that. So there's not there isn't a real strict set of criteria, but there are milestones I think that we'll hit. But I can tell you this, the one thing we're going to do is we're going to do whatever maximizes shareholder value and protects our folks, our employee base. So as long as there's a win-win on that side, that's really the only way we're going to look at something is if it kind of protects everybody. Because we've had groups, I've talked to groups, they've kind of come in and kicked the tires every once in a while. It's not like it's big time information or anything, but you know, my first criteria is, you know, we are plug and play. Like a company could easily buy us and plug us in, and you don't have to do a lot of management with us. You know, we could be out there and be building a drilling or a gold division, or we could be building a rare earth division. To me, the decision-making process is kind of the same on both. It's really more philosophical, I guess, than a checklist.
All right. Well, not hearing any additional questions from the students, I'd like to thank you for your time today, John. You've been very generous. You know, I have to make the bad mining pun that there were lots of nuggets in this discussion. I hope everyone was able to refine them. So, you know, thanks again for your time. I'll post this recording probably this evening and send it out to all of the team so you can review it as well. But thanks again for your time today, and hope everybody learned as much as I did.
Yeah, I mean, if you have, like I said, any questions, send them to us. We're pretty easy. We even do mine and mill tours from time to time. So, you know, kind of keep that in mind as well. So we're pretty open. The guys like to show off what they've built.
All right.
Cool.
All right. Thank you all for joining. Have a good evening.
Yep. Thanks for your time.
Thank you.
Thanks for your time.
Thanks.